All right, good afternoon, traders. So today is Sunday, June 16th, 2024, approximately 4:07 p.m. Eastern Standard Time. So today I wanted to give some updates on from the last strategy and video or strategy video that we did, basically outlining liquidity, the different types of liquidity, um, and different ways to incorporate them into our trading strategy. So today, what we're going to do is I'm going to talk about lessons learned through practical application all of last week and some of the week before, and kind of give some updates on what I've found through the experience of utilizing this particular strategy, and look at some things that I've done to improve on that strategy, what's worked for me, and then what did not work for me, in my opinion, and some improvements that I've made as a result of the experience of utilizing the strategy and liquidity types. All right, so the first thing that I will explain is, and let me make sure I have the right chart here. Okay, so the first thing I'm gonna explain is I'm gonna go back and talk to the liquidity piece, right? So in the last video, we talked about the three different types of liquidity for the most part. So you have your liquidity coming from support and resistance, or supply and demand. We can go with maybe more so supply and demand areas, points of interest, right? So those are your first options when it comes to liquidity, right? Your second option when it comes to liquidity is going to be your fair value gaps, right? That's these areas right here. So basically gaps in the price or imbalances. You know, different people call them different things by different names, right? But your gaps, right, in the fair value. So that's going to be your second option when it comes to liquidity, right? Again, the purpose of liquidity is basically how the big money traders, smart money traders, you know, banks or whoever you want to call them, what they utilize to move the market in the direction that they desire, right? It's all about liquidity. But what I've come to learn and understand is that different types of liquidity work in different ways at different times. So the other part of liquidity that we're going to talk about is going to be just raw liquidity. And basically this raw liquidity, as you can see by the liquidity indicator right here, is basically sitting at your highs and your lows. But it's this particular indicator plots the liquidity based off of the highs and lows of different time periods. So for me, and the way I have this indicator set up, and I'll tell you exactly which indicator it is. So this one right here is the higher time frame or HTF liquidity indicator. And so for me, the red liquidity lines indicate weekly liquidity. So weekly high and low points, highs and lows for this particular instrument. So this is USD JPY on the daily time frame. So all of the red lines on this liquidity indicator are indicative of liquidity based off of the weekly period. So like I said, again, typically this liquidity indicator plots liquidity at your highs and lows for that particular time period. So the green are my liquidity points or areas for the daily time frame. So each green line represents a daily liquidity area from a daily higher lower point of interest or what have you. You don't see it here, but I have the 4-hour liquidity. If I go to the 1-hour chart, which is my normal technical analysis chart or what have you, you can see that the white lines are indicative of my 4-hour liquidity. So basically, these are areas where there was high volumes of liquidity, based off of each 4-hour period. So it doesn't, again, it's plotting the highs and lows for that period and or time frame. All right, so we're going to go back. So one of the things that I've come to learn through experience over the last couple of weeks and identifying these liquidity areas is that, again, like I was saying, the liquidity, depending on the liquidity, is utilized at different times, right? So for me, what became very apparent is in most cases, and I'm gonna go to the 1 hour chart so you can kind of see this. And we do our entries on the 5 minute based off of the daily 1 hour is our technical chart. That's how we're taking our trades, and the 5 minute is our entry time frame. So basically, what I came to find is that liquidity, right? These fair value gaps are typically more so for continuation trades. So basically, in a situation where we see bright price. And this is just the illustration of it, right? So price coming from this area right here, this lower low, right, pushed up, created a change of character, right, and continue to push up. Now, this one was due to news. This was a news event that pushed us up, but I'm using this for illustration purposes. So it created a huge fair value gap. So what we see that was left behind is also a demand zone. So this is your demand zone right here, right? So this is a strong demand zone because it was able to break structure, right? And it also created a fair value gap or an imbalance in the market. So how we utilize fair value gaps are going to be for continuations. If you don't get a continuation right away, then more than likely that fair value gap becomes invalid. Here's what that looks like. So price pushed up, created this change of character right here, created this imbalanced fair value gap, pushed up a little bit more. So again, these are hourly candles. So we had 1 hour where it created it, then another hour pushed up, and then another hour we created higher highs, right? Then we decided to pull back just a bit, right? And pull back a few pips back into this fair value gap. This is how fair value gaps are utilized most of the time. And this, again, is for continuations, immediate continuations. So we saw that when we saw price break, create this change of character, create this imbalance in fair value gap, we wait for the pullback into the fair value gap for our setup and continuation to the upside. That's how that works. We're not going to wait for price to print a higher low, based off of the indicator and things like that. You can wait, watch price come back into the fair value gap and then go to the 5 minute time frame for your entry setups. The fair value gaps are more valuable when utilized as continuations, and it's more so immediate continuations. Again, price came back into this fair value gap 1, 2, roughly 3 hours after being created. Price came back into this fair value gap, grabbed the liquidity, right? Got some liquidity that it needed, right? Because what happened was we probably had some profit taken after this big move right here. Probably had some profit taken, some orders were triggered, whatever the case may be. But price pulled back into this fair value gap to process some liquidity to continue its up move, its move to the upside, right? So that's the timing and utilization of fair value gaps. All right. So notice we get so we had a fair value gap right there. We're not gonna pay that one any attention right now. Again, for illustration purposes, right? This candle right here, right, created a fair value gap. Price goes 1, 2, 3, 4, 5, 6 hours, and then pulls back into it, right? It reacted, it gave a bit of a reaction, but look at what happened. Here's what happened. So price on this up move created another fair value gap and basically did not have the reaction for continuation as we did on this side. More than likely, that was because, look, again, 1, 2, 3, 4, 5, 6 hours before price came back into that fair value gap. So the longer we take to utilize a fair value gap, more likely that it's not going to be utilized for continuation, especially when we create an imbalance in the opposite direction. That's what happened with this one right here, 6 hours before we came back into the fair value gap. So at that point, we really didn't need any liquidity for continuation to the downside. We had pretty much all we needed. And again, this right here was created because of news. So an anomaly, more than likely. But again, just illustrating basically how price reacts to fair value gaps at a given time. All right, so we pushed up past this fair value gap. We see that price did not come back into this imbalance. and fill this imbalance here. In fact, what it ended up doing, excuse me, while my chart resets here. We're gonna let it finish resetting, and then we'll go back into what we were doing. All right, let me do a reset. See if we get it back. If not, we'll set it back up. Okay, there we go. All right, let me set it back up the way I like it. Okay, there we go. Got to get those lines off. All right, here we go. Okay, so as we were saying, as you notice, right, price, again, we created this imbalance here, but price was so strong, the move was so strong that it really didn't need, and it didn't need to come back just yet to fill that imbalance or what have you. And it very well, more than likely, won't come back to fill that imbalance. Not necessarily not fill it, but utilize it as liquidity for a up move, right? We see where we came down a little bit, but it didn't, tap into the fair value gap. Again, the further away price gets from the fair value gap, the less valuable the fair value gap is. So again, that's why I wanted to emphasize, timing is everything when it comes to, utilizing liquidity areas and from points of interest, right? So what that led me to understand, one, is that fair value gaps typically should be used for immediate continuation moves. If not, then we won't look to take a continuation trade off of those. So our main source of price movement for our entries and, for our trades, in my experience, and this is where I had more success over the last week, was when I traded strictly from these supply and demand zones. So we see here, this is a demand zone, another demand zone, and it becomes even more relevant when that supply or demand zone point of interest has liquidity inside of it. So what you do is you wait for price to come back into your supply or demand zone and look for your entries from there. Now, it strengthens your trade success, right, and movement if the trade is taken in the direction, overall direction of the market. So that's where our higher time frame analysis becomes even more relevant and important for us to take, longer trades and be more profitable. Again, if we have liquidity that's being utilized or mitigated for the most part inside of our supply or demand zones, right? So that's where I've had the most success in my trades over the last week, where I took them, waited for price to come back to a supply or demand zone and look to take my entries there. So we can see here where price came in. We see where we created a change of character and price came back, right? Came back into this demand zone and pushed back up, right? Continued up, right? Again, we came back into this demand zone, right? And then pushed right back up, right? Started out, push back up. We see we got a fair value gap right here. So we look for price to, maybe have some reaction or something to the fair value gap, right? So that's where I've had the majority of my success in trading with the overall direction of the trend, right? But utilizing the supply or demand zone within that direction of the overall trend. Now, to make things even better and to pinpoint our entries and timing and stuff even better, another thing that I was able to discover and discern is basically when we're looking to take out trades, right? If you want, a lot of people try to predict what the next candle is going to be. So what I'm about to show you, you want to start off with a daily time frame. You can look at the weekly or what have you, but typically if you're day trading, you're looking for everyday setups, then you start with the daily time frame to get an idea of where the market is moving, right? So you want to kind of, if you want something that can help you to try to predict or understand where the market is more likely to go in your next trading day, start with the daily time frame utilizing some type of momentum oscillator. For me, I'm utilizing the Red K EverX. This one is effort and results. I took everything off, but the oscillator itself, basically, and these are nothing more than moving averages. So you have your slow period and your fast period, or what have you. So your RROF smooth is the white line, and then your signal line is basically the blue line, which turns blue and orange or yellow, however you want to see it, right? So these are our lines that cross each other for trade setups and entries. But that's not the most interesting part of this. What I wanted to show you is, what I wanted to illustrate to you is, if you want to understand or have a good idea what the next trading day is possibly to look like as far as setups and everything, what you want to do is remember this line right here is our signal line for the most part, and this is our smooth line, right? So this is our faster line, right? So basically with this white line right here, if the white line is below, right? So once it crosses, we see where it crosses. This is our signal for, movement and momentum to the downside. So you should be looking for sales. But here's the more important part is, as long as this white line is below this smooth line, right, we should be looking for sales, right? Because the momentum is bearish at that point, right? And I'm going to show you and illustrate to you where this plays out no matter what instrument on every time frame. So if you're trading USD JPY on the 1 hour time frame like I do, go to the daily time frame and see and ask yourself, is the white line above or below the blue line, right? If it's above the blue line, then we're looking for buys. We're looking for buy setups all day, every day, right? So looking at this, right? Just looking at this on the daily, right? Going by that logic, the white line is above the blue line. Now it's close, right? It's really close, which can indicate a possible reversal coming in the near future. But again, for right now, though, the momentum is still to the upside, which means I'm looking for buy setups on my hourly time frame. As long as on the daily, this white line is above this blue line here, I'm looking for buy setups, right? No reason for me to be looking for sales just yet until I get that cross, right? Till I get that cross and the white line is again below the blue line or the smoothing line. Now, the other indicator that you see on here, this right here is a trading view indicator, and this is your volume delta indicator. I found this one to be pretty good at showing the actual delta of the volume or what have you. So we see that in this candle, even though the volume candle indicator has plotted a green candle, right, indicating that bullish, high bullish volume. Well, the volume delta is telling us that that's not really the case. We have more sell volume in this candle than actual buy volume, right? And here I'm gonna show you. Let's take a look. Let's test it out. Let's look at our footprint and see if the footprint if it adds up, if they're saying the same thing. So let's go to the daily on the footprint. Okay. Now, looking at this daily candle on our footprint, we see, let me blow this up a little bit, that the volume delta candle is absolutely correct. We have more selling volume in this candle than buy volume, right? So basically that tells us that there's a possibility in the near future we probably will get that reversal, right? So we wait for those setups in order to enter the market, right? But again, the other thing we want to keep in mind is the overall direction. Right now, the overall direction is bullish, not bearish just yet. So be mindful of that. The overall direction of this market is bullish and not bearish. Let's look at the weekly just to see where we are on the weekly right now. So we're still in a bullish posture. There's nothing right now, and you can see that the oscillator is still showing us overall bullish, right? The white line is still above the blue line. It's close, which indicates that there could be a reversal coming soon in the near future. But for right now, we're looking at buy setups until we get that white line to go under the blue line. So we see that same thing indicative on the daily. Now, if you look at the 1 hour, we see pretty much the same thing. So what we're probably going to get on the 1 hour is we'll probably get across. That's what we want, because we want price to come back down and probably test this order block. There's a lot of liquidity sitting in here. We'll see what that looks like and look for buy setups. So we look for price to come down, maybe even take out, this liquidity below this higher low here for a move to the upside. So that's something to look out for in the near future for possibly the next trading day. Look for price to grab some liquidity before it moves up. Now, price very well could reestablish itself, right? It could reestablish itself, and we can look for that down move, because again, even on the higher time frames, the daily and the weekly, we're starting to see that sell volume and pressure come into the market. So however you want to trade it, if again, it's best, on Sunday, Monday, to kind of look and see what the market is giving us as far as trade setups, but momentum and everything. Momentum is key, right? So again, we know that in the near future, we're possibly looking at a reversal to the downside. But for right now, the USD JPY pair is still bullish, right? So if I put in a trade right now, I'll look to put in a bullish trade, again, based off of price coming into possibly this demand zone or this demand zone here, right? Again, we'll see how price reacts when it gets into these demand zones. We go to the lower time frame. This is the hour time frame. So once price comes back and starts to tap into this demand zone here, I'll drop down to the 5-minute time frame to give me an idea of if price is going to look to move to the upside as it mitigates or as it gets into that hourly demand zone, or is it going to mitigate that demand zone altogether and continue a push to the downside or what have you. So we can look for liquidity grabs, again, just looking at how price reacts. And then again, like I said, you can also use our delta candles to give us an idea of what the volume is looking like. Even though we got a volume indicator on here, which isn't bad, it's not bad. I prefer to have some type of volume indication within my candles to just take away the confusion of the coloration when it comes to the movement of the spread and how the candles, just regular candles, close, and that's what determines the color of the candle. I'd rather my candles up here, my price action candles, be indicative of volume, versus the spread, or what have you. That is more in line with my trading strategy and my trading style, just utilizing volume, liquidity, and things of that sort, and market structure, for my trade setups. So again, you can utilize this process on any market. So let's take a look real quick, just to illustrate, right? Let's go to just DXY by itself. So this is just the dollar. I want you to get an idea of what this looks like, right? So looking at the dollar, okay, and what we're going to do is we're going to go to the daily time frame, right? Now we're not going to get volume because the indices don't report actual volume data. It's all tick data, basically. That's how the indicators are able to display what they display. So in any case, so again, utilizing the momentum oscillator indicator, right? Red K, FOREX, F versus results. We see that the white line for the dollar, right, is above the blue line. Again, indicating buying pressure, more buying pressure than selling pressure right now for the dollar. So the dollar is bullish, right? Let's take a look. And this is the daily. This is the daily, just to give you an idea. Now, we're inside this supply zone here, right? So we'll see how price acts inside of this supply zone. Okay, we'll see if we start to get some downward pressure, some bearish pressure while we're in this demand zone. So we may possibly see a cross. So we'll wait and see what it looks like once this candle closes and the new candle develops for the day. That's why I said Sunday, Monday, you want to kind of see what the market gives you, and then probably start strategizing how you want to take your trades based off of this process. All right, so that's the dollar DXY. Let's take a look at JPY, since that's the other half of the currency pair that we trade. So as we can see, momentum, right? The white line is below, right? The orange yellow line here. Basically, so momentum for the Japanese yen right now is bearish. It's bearish. So that basically confirms our USD JPY thought process of it being bullish, that pair being bullish for right now. So I'm looking for buy trades again on the USD JPY until we see something a little bit different from a momentum place and also market structure. Just to give you one more illustration, let's take a look at GJ. All right, we'll look at GJ real quick and see what posture GJ is taking. All right, as we can see, right here, we see that we have it's a bearish. So for the indicator, the volume candle indicator, it's giving us bearish volume, right? Now we know that the volume delta indicator is actually giving us bullish volume, and we can check it with the footprint. We'll check that here in a second. But look at what the oscillator is giving us. It gave us a cross. So we just got a cross, right? So right now, price is below the smooth line. So we should be looking for sell setups on GJ at this point. And this is again on the daily time frame. We look for sell setups. We see that the volume here from the volume delta is bullish. So let's take a look at our footprint and see what the footprint is telling us. So we're going to change that to GJ, get a good indication of what the footprint is telling us on GJ. And sure enough, the footprint on GJ is telling us that we actually do have more bullish volume in that particular candle than bearish volume. More bullish volume than bearish volume. And we see that bullish volume. So basically, we have trap traders. So we have some trap buyers here at the top. There's quite a few of them, quite a few trap traders here at the top. We see where the bears were able to push the British pound down or what have you, right? So here's what we're going to do. Let's take a look at, so we're going to take this back to one single chart, and we're going to take a look at, let's look at just the British pound by itself. Let's see what momentum looks like. Yep. So momentum on the British pound is actually to the downside. So again, that lends confluence, right, to the downward pressure on GJ. Now, again, we've already looked at the Japanese yen, and we can see that the Japanese yen is also kind of seeing some downward pressure. So we can possibly look at some consolidation since both the British pound and the Japanese yen are seeing a bit of bearish pressure at the same time. So I wouldn't be I wouldn't trade GJ just yet because both the pound and the Japanese yen seem to be going in the same direction from a momentum standpoint. And we can see the other day that both of them were both bearish in nature. The dollar was bullish, which lended itself to a bullish trend with most USD pairs. Okay. All right. I think I've illustrated that point quite enough. Let's go back to our USD JPY, right? And take a look. So remember, our trade setups are coming from, again, for me, through my experience, I've found that it's better to take my trade setups from supply and demand zones for the most part. Again, unless I'm looking for a continuation or something, but I've had more success and better trades, 50 plus pips for each trade that I took last week. I was able to get 50 plus pips when I traded from a supply demand zone. Utilizing that strategy. Again, utilizing the liquidity and everything within that supplier demand zone allowed me to get 50 plus pips. And in both cases with both trades that I took, the market continued actually. Those were trades where I very well could have gotten quite a bit more out of them or what have you, but I had my target set and they hit my targets. So I was okay with that. So again, right now, what I'm looking for is I'm looking for GJ to give me some movement to the downside, tap into this this demand zone right here, and look for some buy setups once it gets into this demand zone. If I don't get a buy setup and price just blows by this, I'll look to see what price does once it gets around this low, this higher low right here. Again, because we could blow through this, mitigate this demand zone, grab the liquidity that's resting below this higher low, and then push up. So I'll look for that as well, just to see what price does as it pushes again into my point of interest. So right now, my point of interest for UJ is going to be this demand zone right here. So I'll be looking to see if I can get a buy setup and a buy trade once price gets into this demand zone. That is it and all that I have for you today. Hopefully this has been helpful to you and it adds to the already dope trading strategy or process that you already have. Good trading. And again, as always, if you have any questions, feel free to post them in the chat and the comments, things of that sort. And I'll try my best to address those at my earliest convenience.